Hey, how's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group. And today's topic, I want to discuss with you fixed annuities and how a fixed annuity might be beneficial for your specific retirement situation. Now, this is going to be part three of our Annuities for Dummies video series. The very first video, just plain Annuities for Dummies, goes over more of the generic version of everything. Now, obviously, as you go through each part, each section, it's going to go more specifically with the different types of annuities out there. So, part one was regarding immediate annuities, part two regarding fixed, and then we're going to be coming out with the index, the hybrid, the variable, etc., to make sure that you could fully understand what are the pros and cons of these types of products and whether it might, suit your needs properly. So a fixed annuity, the most common type of fixed annuity out there is going to be something known as a MIGA, multi-year guaranteed annuity. And this correlates very similar to how any sort of fixed account works, or we could even utilize like a bank CD. Now, like I mentioned before, annuities are offered through insurance companies. Insurance companies are the only ones that can offer annuities. um, CDs, certificates of deposits, could only be offered through banks. So you have different legal reserve structure in there, different entities altogether. Just like a bank can't offer an annuity, an insurance company can't offer a bank CD. It kind of goes hand in hand. So fixed annuities used to be the way to set up retirement planning or retirement income planning. It used to be really, really simple. And the way that it works is if you have like an insurance company that's offering this type of product, an individual would come to a company or go to an advisor and would say, hey, listen, I have $500,000 and I want to have this $500,000. I want to place it into a type of account that's going to pay me a high fixed interest rate, a high fixed rate of return. I do not want to have any negatives to this account. I do not want, if the market crashes, I do not want to, have any less money. I just want to have pure certainty, pure guarantees that there's going to be a fixed percentage rate year by year by year on my bucket of money. Now, that's one portion of how a fixed annuity works. You could go take a lump sum, place it into a smaller term contract, such as like a 5 year fixed annuity or 6 year, 7 year, 3 year, 4 year, whatever that is. Understanding that if you go and you have a 5 year, well, this is going to pay you a lower rate of return than if you had a 9 year. How does the company do that? Well, they will give you a higher incentive that if you want to go and place money in with their company longer, they will give you a larger incentive, and therefore that incentive would be passed through that guaranteed interest rate. So you might have a 5 year product that's paying you 3% of a fixed annuity, fixed MIGA, interest rate year by year by year, but a 9 year might be paying you 4%. So the company was just saying, okay, well, because Mr. and Mrs. Jones purchased this annuity, they purchased it for a longer time frame. We now have access to hold onto this money longer, so therefore we could try to make more interest on the back end and still provide them that guarantee of that 4%. So that's the only major difference. Somebody could go and say, okay, listen, I'm 55 years old and I have money, whether that's in cash account from an inheritance, from they sold a house, they sold a business, whatever that is. This individual could say, hey, listen, I'm not interested in really touching this money just yet. I want to see, how much this money could grow on a fixed basis until I'm age 60 or until I'm age 63 or 62 to correlate directly with Social Security when you start pulling out Social Security income. So you could go and take this $500,000 amount, place it into a 5 year, a 5 year fixed annuity. You could place it into that shows an 8 year fixed annuity, or this one shows a 7 year fixed annuity. And you understand maybe the 5 year fixed annuity is paying you 3%. Maybe the 7 year is going to be paying you 4%, and then maybe the 8 year is going to be paying you 5%. So the longer that you leave your money locked up, the higher the rate of return could be. This is just like thinking of like a bucket of money, okay? A bucket of money with 500 grand in there, or $100,000, whatever number you want to use. If with a lid over it, every single year from inception, when you sign over, when you set up that contract, you understand that your money's still going to be sitting there. But after each year passes, so from, let's say, if you set up your contract on November 1st of 2015, November 1st of 2016, if you had something that would give you a 3% guarantee, then they're going to open up that lid, pour that gain inside, and now you have a larger bucket. Some companies allow you to pull out that percentage, whatever you're getting credited, that you could actually take that money year by year by year. And that's how income planning used to work. Individuals were able to utilize something known as a laddering strategy to provide a perfect combination of liquidity and a good interest rate. What do I mean by that? Well, before I taught you that when the longer that you leave your money locked up into a certain entity, whether that's with a bank or an insurance company, the higher that rate of return should be. Depend upon how the interests are being paid. Meaning, if you have like a 1-year bank CD, that's going to pay you a lower percentage rate than a 5-year bank CD. So back in the 1980s and 90s, where you had interest rates were in double-digit figures, you would have an individual that said, okay, I have $500,000 of income. Well, rather than having them just throw $500,000 in a 1-year bank CD, which they could do, this would produce, let's say, maybe 4%, and we'll go by 1 year, 2 year, 3 year, 4 year, and 5 year. So maybe the 1 year would produce 4%, 2 year 6%, 3 year 8%, 4 year 9%, and 5 year 10%. So rather than just keep placing that money and then getting a new CD, getting a new bank CD, a new bank CD, what individuals would do, and a lot of bankers were very important, very successful in setting up these strategies, was they would say, okay, out of this $500,000, let's place $100,000 in a 1-year CD, $100,000 in a 2-year CD, $100,000 in a 3-year, et cetera. And I apologize for my sloppy handwriting, as you see that my digital notepad keeps scribbling all across the screen. But what this would do is after the first year, this person would collect interest on 4%, 6%, 8%, 9%, 10%. So that after this came due, this person would take this $100,000. If they had a need for it, then they would use whatever portion that is. If they don't have a need for it, then they would repurchase a new 5-year bank CD. So what that would do was now have the 5-year only have 4 years left, 4 years only have 3 years left, 3 years 2 years left, 2-year would only have 1 year left. So the next year after that came due, they would just purchase a new 5-year bank CD, so that you're always getting that top of the line high interest rate year by year by year. So that same concept made fixed annuities very, very attractive. Now, a lot of people think of annuities of saying, oh, no, this is income stream. I have to annuitize my money. And that's not what I'm talking about, especially with fixed annuities and multi-year guaranteed annuities. You never want to annuitize your money on those types of products. So how a fixed annuity works is maybe, with this structure of saying the 1 year is paying you 4%, but the 5 years paying you 10%, because it's set up through an insurance company, these insurance companies typically offer a lot higher rates of return than with the bank CDs. So an individual could still set up that laddering strategy of saying, okay, $100,000, for a 1 year, a 2 year, a 3 year, a 4 year, or 5 year, or you could even do a combination of bank CDs and fixed annuities. And what this would happen was maybe the 1 year was paying 6%, maybe the 2 year was paying 8%, the 3 year was paying 10%, then you had 11%. Then this was paying 14%. So what you're doing is you're leveraging your dollars in a better way, that after each year you would collect that interest that you would have earned. You receive all that interest as income, but you're preserving your account value the entire time. So when you're going from bank CDs and fixed annuities, a fixed annuity typically pays higher rates of return, and that's why individuals go to that, fixed annuity route over the bank CD. But where it gets complicated is thinking of the words annuitization and thinking about purely as income. No, you could set up your money kind of just like a bucket of cash. Now, whether this money is in cash or whether this money is in a retirement account, you could go and use IRA monies, 401k monies, to then roll over and purchase these types of IRA fixed annuities, the IRA MIGAs. So it's just like a bucket with that lid over it. If you go and you set it up the right way, you could have a 5-year product that's paying you 3%. And this is why a lot of the planning, a lot of the retirement income planning has gone by the wayside, because you have specialists, they call themselves specialists, and all they did was just do something so simple as a laddering process, a laddering strategy with banks, or financial advisors would do that with fixed annuities. Well, now we've seen in these past 10 years or over 10 years, we've seen all-time low interest rates. So now that 5-year bank CD or that 5-year annuity that's paying you 10%, now you'd be lucky if you could have a 5-year bank CD that's paying you, 1.2%. that 5-year, fixed annuity that was paying you 14%, now you'd be lucky if you could have a 5-year fixed annuity that's paying you 2.9% or 3%. So individuals that still have that safe mindset that says, I want to know, God forbid, worst case scenario, I want to know every single year that I'm at least getting 3% rate of return or 2.9% rate of return. This is why individuals purchase MYGA contracts or fixed annuity contracts in today's times. If interest rates go higher, income planning is going to be a piece of cake. It's going to be so much easier. Now, you're going to have some advisors that do not want to offer these types of MYGA products because of the fact that it takes away on their commission, because it's such an easily set up contract. All it is just a fixed interest rate. These are going to pay advisors the lowest amount of commissions. A major reason why I don't why I don't necessarily always utilize the MYGA route is because the interest rates are so tiny that I believe you can get a better route going with an indexing strategy. But I do have a lot of clients that still utilize MYGAs, especially some of those old school train of thoughts that say, you know what, I want to have a 4-year product or a 6-year product or a 7-year product. And then what we try to do is find them the sweet spot. So with our agency, and let me pull up we have access to every single company out there. We're an independent financial agency. So we have access, depending upon what your state is, depending upon your area, depending upon your age, your specific situation. We offer all the top fixed annuities out there. On top of it, you have companies that, and I'm not going to name any names, but you have some contracts that are complete garbage contracts. It might be showing you, a 5-year fixed annuity that's paying you 3.1%, but then they have so many stipulations against that 3.10%, when in actuality they're only paying 2.85%. After they charge you rider fees, or you can't actually get that money, you can't touch this money until after that 5 years is done. So what we try to do is really go toe to toe with these companies. We represent these companies, but at the end of the day, myself, and I've taught all my advisors, all my different agents and representatives, we're going to be out for the client's best interest. I don't care which company is going to come out first, second, third place, as long as it's the correct position for the actual client. And what do I mean by that? Well, if we go and and I have this every single day. I take on phone calls, or my representatives take on phone calls every single day. And let's say somebody's interested in a fixed annuity, and they say, okay, well, listen, I have $500,000 that's sitting here. I want to see what the top 5 fixed annuities are. Well, that's going to be a really simple chart. You could probably even find that chart online. Now, we have access to every single carrier that's going to be your top spots. But many times, when you see these top rates of return, individuals make the mistake of just jumping into it and not understanding what the cons of it are. One example would be, and there's one company, I'm just going to consider them company ABC. I saved a client recently from this. This client went and got set up with this contract. It was a 6-year fixed annuity. And this fixed annuity, the first year was paying him 3.10%. Then it had specifically written in the contract that they could now adjust their rate to the discretion of the company, that it was only the first year rate was 3.10%, but every year going forward is now going to be based upon the discretion of the company. So when hearing that, of course, when interest rates still stayed low, this guy was assuming 3.10% rate of return in year 2. What do you think the company did? Did they keep that rate, or did they go to the discretion of the company? They went down to the discretion of the company. Well, now they're paying him 1% rate of return this next year. So we had to go and do some different types of plannings to get him out of that contract and into something that will at least recuperate and make sure that he has a much higher guarantee. This is a very common mistake, especially in the fixed index world. So you want to make sure that it clearly states, if you have a 5-year product or a 6-year product, or whatever long that amount of time is, that you see clearly stated that this 3% or whatever that number is going to come to you for every single year for the length of the contract, that they cannot lower that guarantee for the discretion of the company. Another thing is, sometimes you have contracts set up where you might have like a 5-year fixed annuity, but you can't touch any money. You can't take out any money whatsoever until after that 5th year. That's another thing that I call a garbage product. If you're getting, let's say if you have the first company that's going to pay you a 3% rate of return, or you have and that's going to be 3% every year for the next 5 years, or you have the second company that's going to give you 2.90% rate of return, company A is only going to allow you, they won't allow you to touch this money at all, to be able to take out any of that interest, that you could only touch this money after that 5 years is done. Or you have company B that allows you to pull out interest only every single year, that you have a gain, you can now pull out that gain. You have a gain, you can now use that gain for income. This is going to be a lot more flexible contract, a much better contract. Or this company might allow you to pull out up to 10% of what your account value is. So it's always controlling, making sure that you're keeping as much control in your pocket for as long as possible. There's a lot of companies we represent, and there's a lot of times I never will offer that to the client, or never even give that recommendation, to my client, because it's not going to be correct for them. And I always use the same phrase. I say smoke and mirrors approach, meaning it's like a magic trick. They're trying to get you suckered into a contract just to make sure that they're controlling the chips on the back end the whole time. So that's some of the things that we do a little bit differently, and we make sure that you're going to be fully educated whether or not a fixed annuity is right for your position, or whether or not there's something else better out there. We do have a lot of volume with individuals that are looking for the best fixed annuity contracts. They just want to go with more of an honest advisor that has a whole arsenal of it. We definitely set up that educational process. We would be the representative and getting them set up in those contracts. It doesn't take away from any sorts of guarantees to them. It's as if they're going directly to the company, but they just understand that now they have a representative in their corner. So we could set those up really easily. We are A+ rated on the Better Business Bureau, and that's because of our educational process. And one of the things I always mention is I say, I love educating people. I love an informed person, an informed retiree, or just an informed individual, because you're going to be able to see what's a good product or what's a bad product, or what was fluff, or whether an advisor knows what they're talking about or they don't. So this is why, this is kind of my passion, to make sure that I'm making you guys aware. And once again, in retirement, you only have one shot to get things right. You do not want to mess up. You want to be on a methodical process. You want to be fully educated, and you want to make sure that you have access to all the best carriers and companies, on a national basis, or even in your specific area. So, I want to thank you very much for watching this video. Please make sure to subscribe to our YouTube channel, Retire Sharp, so you have access to the most updated videos. And I want to thank you very much, obviously, for watching this. And I look forward to you either taking your call personally, or at least, look forward to you dealing with my company. Thank you so much, guys.